Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
Hello, everyone. Welcome to episode 5 of the Bigger Cash Flow podcast. And today's episode is called Why Real Estate is Your Ideal Investment. So last week, we discussed why many investors use real estate as an asset class to grow their wealth and the different types of real estate investing, such as wholesaling, flipping, Airbnb, and buy and hold real estate. Today, we want to take a deeper dive into buy and hold real estate, as a majority of the investors that we talk to seem to fall under this bucket. So before we get started, I want to share this quick quote of the day with you. And this is from our very own Robert Kiyosaki, author of Rich Dad, Poor Dad. And he says, real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. Joe, what is your take on this quote?
I really like this quote a lot. I especially like the fact that it says even on a very small scale. And it reminds me of how most of us get started, whether it's house hacking or, your first buy and hold investment of buying a single family home. And it's amazing how quickly, over time you can grow that portfolio from one property to 2, 3, 4, 5, 6. And both of us have experienced that kind of growth in our portfolios. And also over time, I've seen both cash flow and wealth, increase dramatically. And I've been doing it for 5 years. And it seems like I started with one, but at this point, I feel like I've really experienced a lot of tremendous growth in both the wealth part and in the cash flow. So I think this is a very, a relevant quote for most of us who are not born with a silver spoon in our mouth. So yeah, I think it's a great quote.
Yeah, no, I totally agree, because depending on where you're investing, typically maybe investors are seeing, $200, $300, $400 a month in cash flow. And other people might view that as chump change and say, oh, that's so small for me. Like, what am I going to do with $200, $300, $400? But if you think about it, you're really creating, small habits and scaling up your portfolio. And with the additional $200, $300, $400, maybe that's a car payment, or maybe that's paying for the groceries or utilities. And it's slowly, putting building blocks in place to put you in the right path of financial freedom. So I agree, even on a small scale, it's a great way to build cash flow and wealth. Mm-hmm. So with that said, as mentioned, today's episode is titled Real Estate is Ideal. And we want to dive into what ideal stands for. And I stands for income, D, depreciation, E, equity paydown, A, appreciation, and L is leverage. And we're going to take a moment to discuss each of these topics. And basically, why we wanted to do this episode was a lot of, newbie investors, reach out to us and ask, hey, what's the best way to get started? Is it wholesaling, flipping, Airbnb, you name it? And my answer is there's never a clear-cut answer. It really depends on your temperaments, how much time you have, how much capital you have. Do you want to be a landlord, or do you just want to be a private investor, like investing, in hard money or private lending or whatnot? So let's take a look at, your traditional buy and hold real estate and some of the benefits that this will bring you. That's very different from other types of real estate investing, such as flipping or wholesaling. So I stands for income. Basically, why we invest in real estate is it provides consistent income right? As long as you buy right and you have a tenant in place and it's cash flowing, you should be able to get monthly income. If you take a look at it from the perspective of rental real estate, and you have a $100,000 asset in the Midwest and you put 20% down, so let's just say with closing costs, you're all in roughly at $25,000. Now, let's say this property meets the 1% rule and you're able to get it rented out for $1,000. After all expenses, taxes, insurance, property management, repairs, and reserves, it can typically net you about maybe $600. Maybe 40% goes to these expenses. And then you deduct your mortgage, maybe it's $350 to $400, and then you have $200 to $250 a month net after all expenses and debt service. So this is your net income, and this is going to be pure cash flow. What are your thoughts on this, Joe?
Yeah, no, that's exactly describes my first turnkey deal that I did in 2013, which was a $100,000 home in Houston, and I put 20% down, and my rent was $1,200. So that's slightly more than the 1% rule, because 1% would have been $1,000 per rent per month. And however, my cash flow was about, I would say, 300 to 350 a month. Some of my, unexpected or more than expected expenses were higher taxes. Texas has a higher real estate tax than most other states, and some more maintenance than I expected as well. But at the end of the day, I was still making around $300 to $350 a month positive net cash flow. So yeah, that's how I started off with my very first investment property.
That's awesome. So D in ideal stands for depreciation. And the IRS tax code as of 2018 allows you to take a legal tax deduction on the depreciation of the property over its useful life. So you're going to depreciate the building, not the land. And that is currently at 27 and a half years for residential and 39 years for commercial property. So the beauty of this deduction is that it's an on-paper deduction, meaning that your property isn't necessarily going to degrade at the same level as you're taking these deductions, right? Your property can be physically fine for 5-10 years, meaning like you don't have to replace the roof yet or the sidings or whatnot. But on paper, you're consistently taking a straight line depreciation. So in this example that I mentioned to you above, $100,000 property in the Midwest, let's just say 30K is the value of the land and 70K is the value of the building. So now you divide the 70K value of the property by the IRS standard of 27 and a half years for residential real estate, and you are getting almost $2,600 in annual depreciation losses that is offsetting any income generating from your income. This is a huge benefit because even though you're actually putting, $200 to $250 in your pocket each month, from a tax standpoint, you might be operating at a loss and you might be accumulating these passive losses, and you're still able to use the $200 to $250. So imagine you're working at your W-2 job and you're getting paycheck after paycheck and you're able to spend that money without any taxes. Wouldn't that be wonderful, Joe?
Yeah, no, that's one of my favorite things about real estate investing is all that tax benefit. The IRS and the federal government loves to give us that tax, discount in a sense. And I just love it that the profits you make in your, monthly rentals is really offset by your depreciation loss mostly. And therefore, it's a tax-free. I mean, what you make is what you take home, what you put in your pocket, which is fantastic. Because if you look at your paycheck, that's not the case. The very first time I got my first big paycheck as my W-2 job, the biggest thing that surprised me was how much money was taken out for taxes. So I think this is a fantastic investment in that way. But that being said, I think the one caveat to the depreciation is the depreciation recapture that occurs when you sell the property. So what that means is that when you sell, all that depreciation loss that you had actually taken will be will need to be paid back, meaning your cost basis will be reduced based on the amount of depreciation you took, and therefore it makes it seem like at the time of sale that you gained a large portion, large increase in the sale price minus the cost basis, and therefore you'll have to pay taxes on that. So the taxman will always want their money. However, there's this wonderful loophole that the federal government gave us, which is called the 1031 exchange, which means that you can defer those taxes again by buying another property under this 1031 exchange, which has certain rules and timelines. But you sell one property and within a certain amount of time, you buy another one, and therefore you can offset or defer your tax burden onto the next property. And so you don't pay that tax. And you can actually do that until you die. And then when you're dead, you don't have to pay those taxes.
Yeah, definitely want to remind you guys, please consult, your lawyer or CPA and your real estate team to figure out how this exactly applies in your situation. But like Joe said, although there is, the con of the depreciation recapture when you're selling your asset, there is the 1031 exchange. And it kind of reminds me of playing Monopoly and trading up, right? You have those little greenhouses, and then, when you're ready, you can trade up to a hotel. I think Brandon Turner of Bigger Pockets kind of paints a picture of how you can grow your real estate portfolio using the 1031 exchange. Like, let's just say you start with a single family home and then you exchange into a duplex or a fourplex, and then you exchange up again, kind of deferring those taxes to 16 units, 32 units, and those units will provide you lifetime cash flow while you're alive. And then one final way is, let's just say you kick the bucket and you leave your portfolio to your heirs. Well, at that time, it gets reset, and, the tax basis gets reset at the time you die. So you basically deferred those taxes forever.
Yeah.
So that's another method that I've seen investors use. As long as you're just in it for the cash flow and you're not looking to sell, they continue to trade up and then pass that along to their heirs for generational wealth.
Yeah, that's fantastic.
So next, Joe, do you want to cover equity and appreciation?
Yeah, sure. So E for equity. So every time you have a rental, not only do you have to think about what you gain in terms of your positive cash flow, the tenant is not only paying your rent and the mortgage interest, they're also essentially paying down the equity or the principal of the mortgage. And therefore, you're gaining positive equity in your property every month as your tenant pays the rent. And I really love that scenario because I actually experienced this myself in one of my properties in Orange County, California, and I had to rent it out because I was underwater like everyone else in 2009 during the recession. And I had it rented for about $2,400 a month. But my pity, the principal, interest, taxes, and insurance, along with any other extra costs, almost matched my rent itself. So I was making basically like $100 above, my expenses, or maybe just breaking even. So it looked like a really bad investment. But, one of the good things was that I avoided foreclosure, by doing that. Because at that time, I didn't know I was becoming a real estate investor by renting it out. I was an accidental landlord. But when I look back over the 5 years, what happened was during those 5 years, my tenant was paying down $1,000 a month in principal. So I was making $1,000 in equity every single month on that property when I was making almost no cash flow. So there is, I mean, I'm not trying to say that that's what you should do. You should go for zero cash flow. But I think there are other benefits in real estate investing that adds to the cash flow, which is that equity, which is fantastic. How about you, Bo?
Yeah, I think you make an excellent point because, typically when real estate investors are analyzing these deals, you have your vacancy losses and you have your, property taxes, insurance, maybe property management fees if you're using a third party manager, and then you have some maintenance capex reserves. But you don't really think about the equity pay down in your numbers. At least I don't. I know some investors like to put that in after the fact, maybe like a 2% appreciation or 1 to 3% in lines with inflation and things like that. But I typically look at, the net income after your debt service and what that cash on cash looks like to me. I typically look for, 14% and above. If you're thinking about it, you're totally right. I mean, I have a primary residence that I own. The thought that the real estate agents pitch to you is like, hey, if you buy a home, you're throwing your money away with leasing, right? And in 30 years, you'll own this home free and clear, and you can pass it down to your kids, or you can sell it or do whatever. But the same thing applies from the investing front, where you're getting that cash flow, but if you think about it, the tenant is paying all the expenses as well. That's why we do the deal, right? Because it cash flows after all those expenses.
Yeah.
So like Joe said, let's just say you, for some reason, there was a blizzard or a tornado or whatever, and maintenance and capex was high that year and you broke even. Well, not necessarily, because you still have the tax benefits, maybe the loser in your portfolio would offset the gains in your other portfolio with depreciation.
Mhm.
And further, with this equity, even if you break even, your tenant is still paying that note off for you. And in 10, 15, 30 years, you're going to get that home free and clear. So I think it's something that investors should definitely keep in mind and not overlook, because it's a huge benefit.
Yeah, no, I definitely agree. And actually the more pricier the property, the more expensive the purchase price of the property, the more you're actually going to get in terms of equity pay down each month. So that's an interesting part that has to be balanced out with the cash flow. And then same thing with the next part of that EA equation is the appreciation. And I think we all know that appreciation is something that we can't bank on. It's not guaranteed. But at the same time, I think that's something that, that's a fantastic part of real estate that can happen when your property is actually getting the depreciation loss tax benefit. You're also getting the appreciation gain, which can be a huge wealth generator over a long term. And so I really love that part of real estate. And I know that, you can focus on one thing versus the other. But certainly I think it depends on which markets you're also investing in. I think in markets like here in California or along the coast, where there is wide swings in appreciation or increasing in price and decreasing in price, appreciation is something that you can try to strive for during the right times. And I'm in the camp that it feels that you can time things to a certain extent, not to the month or the year even, but I think there are seasons of growth and seasons of downturns that are much slower with real estate than, let's say, for example, stocks. You really unless you're a stockbroker, even if you are, you can't predict the movement of the stocks that closely. But I think real estate moves a lot slower, and therefore you can take advantage of some of those advantages of being able to time the market to some certain extent. That being said, you still don't want to be in a negative cash flow situation, because I think that's a dangerous place to be, assuming that you're going to get appreciation.
Yeah, I totally agree. And with appreciation, I think there's two types that we want to point out here. There's the forced appreciation, and then there's the market appreciation. And
Hmm.
like Joe alluded to, typically on your West Coast markets of, LA, San Diego, San Francisco, and then New York on the East Coast, there's big swings up and down, right? But then also there's your hybrid markets of Texas and Florida, and then you have your more steady Eddie, Kansas City, Indianapolis. Those markets are not going to swing as largely as your coastal markets.
Mm.
And the great thing about appreciation is that you can force it. And what I mean by that is a method called the Burr method. So in bigger pockets, there is a term that's tossed around frequently called the Burr method, and it stands for buy, rehab, rent, refinance, and repeat. And in this strategy, you're buying homes, from a foreclosure or an auction or a wholesaler who's selling a distressed home, meaning it needs some work, and you're going to do some value add. You're kind of like flipping it, but you're flipping it to yourself. So once the work is done and you have a cash flowing tenant in there, you're going to now take that free and clear asset to a bank institution and say, hey, do you want to put a mortgage on it? And they're like, why, certainly. I'd love to make 10 times my money. So they'll put a note on it for you, and you're going to get the newly appraised value. So if you bought it for 50,000 and you put in, $20,000-$30,000 worth of work, it might appraise for 110, 130. And the delta of your all in, let's just say 70,000 in this example, and if it appraised for $100,000, that delta of $30,000 is the equity that's forced. So you didn't have to wait 5-10 years for that property to appreciate over time. You are able to do that in 2-3 months because you've just added a ton of value in that home and you just made it prettier. So that's a huge benefit that I like to do, is the Burr method. And that's a great way to scale because you've basically created equity out of thin air through your hard work. Now, I'm going to caveat that and say there's a lot of risk involved. There's the rehab risk, and there's the risk of you managing the rehab, things going sour. There's holding costs. There's a lot of risks involved, but the benefit is very large as well.
Yeah. No, I think that's my favorite kind of appreciation, is the forced or appreciation that you have control over to some extent. Because the market, you can never tell, there are certain places where you predict gentrification, and what if that never happens? Or what if the laws change, or, the city goes bankrupt, or some other external force that you have no control over. But I think in terms of like better control, you have a little bit better control over your rehab, or whether or not you're going to add an extra room or a bathroom to a home. So I think that's a fantastic method. And I'm actually, just very impressed that you've been able to do that, Bo, from far away, from California to Kansas City and Indianapolis. So I think that's fantastic. Can you talk a little bit more about like a specific deal that you just done recently using the Burr?
Yeah, I'd love to. The listeners might be wondering, like, how does this work? Like, how are you able to buy a property so distressed and put some work into it, and it's going to appraise at that value, right? So there's a lot of things to consider, like the ARV, which is your expected value of the home after it's been rehabbed. You have to have the right team to make sure that you're buying it at a discount in the front end. So a lot of people will tell you you make money in real estate when you buy. And then you got to make sure the rehab quote is accurate, right? Because you might make an offer for a property at $50,000 thinking you only need to put $20,000 worth of work in it. And then lo and behold, you open up some walls and there's a lot of issues, and there's issue with the pipes, and you got to do $20,000 more. Now you're all in at $90,000. And this is not including closing costs or holding costs, maybe financing costs if you're using a private lender or hard money lender. And then you have the risk of it not appraising. If you thought it would appraise for $100,000, let's just say it actually appraises at 90. Now you're all in at $90,000, which is the value of the home after it's going to be appraised for. Then you're kind of screwed because you're being squeezed out of both sides, right? So this was what I was referring to earlier about there is a lot of risk involved and you have to be sure of your numbers. And the way you do that is experience and also leveraging other people's time and knowledge. And we're going to get to L in a moment. And when we talk about leverage, it's not just talking about money. You can leverage other people's time and knowledge to make sure you're successful. And the neat thing about using this BRRRR method is that these markets, they're very local. And I heard this term when I first started and I didn't quite understand it, that real estate is local and these markets are largely inefficient. And what that means is that, like Joe alluded to, there are these paths of gentrification and things move slowly enough in cycles where you can get ahead of the curve. And if you know the right people and you have the knowledge and experience, you can take advantage of these inefficiencies, and that's where you can make your money.
That's fantastic. I love that. The one example I have of the other appreciation, the natural market appreciation, is a house I sold in Texas. I bought a single family home in San Antonio for $126,000. Rent was about $1,200 a month. So I was cash flowing maybe about $200 a month after all expenses. So that wasn't that much in terms of cash flow. But fortunately, San Antonio was really hot over the last 3-4 years. And appreciation in Texas, which has been a surprise because Texas is typically not a market that appreciates, but in the last, this market season, it really has done pretty well. And I actually sold that house in 2017. So 2 years of holding this house, only 2 years. I might have made maybe, shy of maybe $5,000 in cash flow, but I bought it for $126,000. I sold it for $180,000 in 2 years. So the difference in sale price to the purchase price was $54,000. So when you look at the $54,000 in appreciation versus the $5,000 in the 2 years of cash flow, certainly, appreciation is not something you can bank on, on the market. Nobody knew that Texas was going to really, blow up like that. But when you do get appreciation, man, the power of that appreciation is tremendous because I didn't put in $54,000. Because it was leverage at 20%, I only put in about, 20% of 126, which is like shy of $25,000. So if that's over 200% in a return, right? If you put 25 and you got 54 back, just in 2 years, that's amazing, right?
Yeah.
So I think, that's why for me, I really think that, unless you are doing a million deals, you should try always, if you can, always buy a property that has a slightly better appreciation potential. Whether it's you can force appreciate it, or if it's in an area that's being gentrified, or if it's an area that let's say, a large company is coming in and there's going to be a lot of population growth, some kind of added value where the home price will go up. I think it's something that you should always keep an eye for, because that one little component, it can be a huge, huge part of your return, of your ROI overall. So I think that's something to always keep in mind.
Yeah, no, I think that's a great tip because, when I was first starting out, everybody kept saying, cash flow is king, cash flow is king. And I agree. I mean, the fundamentals of my portfolio is based on cash flow. I mean, appreciation is icing on the cake. But if you think about it, like you just said, Joe, in 2 years, you had an appreciation of what, of $54,000, you said?
Yeah.
Yeah. So how at $200, or let's just say, that cash flowed really well at $500.
Yeah.
How many months of $500 net cash flow, meaning everything else has to go right in terms of vacancy and capex? How
hmm
many months of that would you need to even, scratch the surface of that $54,000 appreciation?
Yeah. Almost like 8, 9 years, right?
Yeah.
Yeah.
And
Mhm.
and yeah, that's a great point. And I'm not saying that, appreciation is strictly what you should go for, but I'm just definitely echoing what Joe is saying in terms of, maybe if you're deciding between two properties or you're looking at location, talk to the locals. That's how you get the information. That's what I do because I am an out-of-state investor and I don't know these streets as well as some of these brokers and other local investors. So, I take them out for coffee or lunch and I ask them, hey, have you heard anything? Is there a big player coming in? Is there certain streets where flippers are flipping? What's going on? And they'll tell you, hey, the street, it's, seeing a lot of activities, and you want to target that street and buy the ugliest house on the nicest block, because that means it has a lot of meat on the bone, whether you can force appreciate it or if you slowly repair things over time. Let's just say you don't have $20,000 to rehab it right away. Well, even if you do it slowly over time and kind of watch for the market to jump up, and then you do maybe like a retail rehab and then you sell it to a first time home buyer. What I love about this strategy is there's so many exit strategies, right? You can just do like a regular rehab for a tenant in there, and then you see, the market starting to gentrify for the street, and then you do maybe like a $30,000, $40,000 rehab that you wouldn't do for a tenant, and then you sell it to a first-time home buyer.
That's fantastic. Let's move on to the leverage.
So last but not least, the L in ideal is for leverage. And leverage is a very powerful tool that allows you to use other people's money. So in this case, the bank to finance your purchase. And of course, there's risk involved whenever you're using other people's money, as nothing is free in life. However, when you mitigate the risk by making sure your investments are producing sound cash flow and it's in a strong rental market with favorable landlord laws, and you have the right team in place, you'll be able to scale much faster than if you were not to use leverage. And as mentioned before, leverage is, you can use other people's money, OPM, but you can also use other people's time and knowledge. And that's what I really try to tap into when I'm first starting out. Because I'm educating myself by talking to other people. And these guys, like my property manager, probably has experience managing like 1,500 doors, and then now they started their own company and they have like 200-300 doors and many years, like over a decade under their belt. So they've seen a lot, right? They've been through dips, different market cycles, and they're able to tell you, how to screen for tenants, what to look for in a real estate property, and also they're able to advise you in terms of what they would do. Because sometimes as landlords, you might think, hey, I want to do this type of rehab because that's what I would do to my primary residence. But for them, knowing the market and knowing the tenant, they understand that, these type of tenants, maybe they don't need a granite countertop. They'll rather take $50 less in rent. So they're able to give you the right kind of advice in terms of how to scale up your portfolio. So, in terms of using other people's money, going back to the first example that we had with a $100,000 home, let's just say you use a traditional Fannie Mae conventional lender with 20% down and closing costs. Maybe you're all in at roughly $25,000. That means you'll have an annual net income of about $3,000 or $250 a month. So that's a cash on cash return of about 12%. And it doesn't factor in, depreciation of $2,600, appreciation of 1 to 3% based on the local markets, and then as mentioned, equity pay down of roughly 3 to 5%, bringing your total return on a single property maybe about roughly 20%. And when you project that out 30 years with, increase in rent rates, it just simply makes buy and hold real estate a sound investment.
Yeah, I totally agree. I love leverage. I love that idea that Robert Kiyosaki says, use debt to get rich, which sounds on the surface like, an oxymoron, right? How do you get, riches from debt? And I love that concept of good debt versus bad debt. Good debt being uh, using money, other people's money, to have a cash flowing or an asset that is making you money, not an asset that is just depreciating or not making you any money. I think the best example is a car. Car is one of the fastest depreciating asset that does not produce any money for you, unless you're an Uber driver or some other, unless it's part of your business itself. So I totally think that this is one of the best, one of the rare things that I think you can use to increase your investments and increase your ROI over a long time. And I love that part about real estate. And I've definitely benefited from that in terms of leverage.
So just to tie this all back together, so Robert Kiyosaki said in his book, Rich Dad, Poor Dad, the poor and middle class work for money and the rich make money work for them. So you might be wondering, when is the right time to start investing? There's so much more information. And I like to tell them this quote, don't wait to buy real estate and wait, because once you have the knowledge, if you're just continuing to analyze deals and not taking that first jump, then you're going to be stuck in analysis paralysis. But I call it the first deal rule, is where you do your first deal and it might not be the best deal. I mean, speaking from personal experience, my first deal out of my now 10 properties that I have, it's the worst one. I actually recently went through an eviction and, about 4 months worth of negative cash flow, but it allowed me to scale up and do these other types of creative financing, the BRRRR method, seller financing, all this good stuff, because I took that first step. So I want to remind people, take that first step and just start to educate yourself and avoid analysis paralysis, because you'll be so much happier that you did.
Yeah, I agree. I've benefited over those last 5 years doing the buy and hold. And it's amazing how time, passes very quickly, and how much wealth is created during that time when you're investing.
Well, guys, that wraps up our show for the week. If you thought that was helpful, please do us a favor and leave us a review on iTunes, Stitcher, or wherever you may be listening. We appreciate your support, and until next time. Thank you for listening to the Bigger Cash Flow podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.